So today we start with depreciation topic covered under IAS 16. Normally, depreciation is going to be defined in three words: gradual, continuous, and permanent reduction in the value of an asset. So the concept of depreciation is that it is a gradual, continuous, and a permanent reduction. Gradual because it takes place over a period of time. It is slow. Continuous because it does not stop at any point of time. You can't say that there is no depreciation on Sunday because Sunday we are not working. So depreciation takes place every day. It takes place every time. Even if you don't use the asset and just keep it like that, depreciation will take place. Permanent reduction, once the value of the asset decreases, it does not increase because we are using the asset, so there will be wear and tear. How does IAS 16 define depreciation? It is the systematic allocation of depreciable amount of an asset over its useful life. What is the depreciable amount? It is a numerator. The numerator is what? Cost minus estimated salvage value. Formula for depreciation is cost minus salvage value divided by estimated life of the asset. So the numerator is your depreciable amount, which is divided by life of the asset. So depreciable amount is the cost of an asset or any other amount substituted for cost less its residual value. So cost minus estimated salvage value. Depreciation must be charged from the date the asset is available for use and not from the date on which the asset is put to use. So many times they will give you problems where this particular point will come up for discussion. So building is constructed. Let us say you have asked a builder to construct an office building for you, administrative building for you, and it is ready by 30th June. But you occupy the building on 1st August. That doesn't mean that depreciation will start from 1st August. Depreciation will start from 1st July. 30th June when the construction is completed and building is ready and available for use. So from the date the asset is available for use. That is, it is capable of operating in the manner intended by the management. This may be earlier than the date it is actually got into use. So as I told you, you bring it into use on 1st of August, but the building is already ready by 30th June. So by 1st of July, you should have started. But we have started on 1st of August. So date of depreciation will not be 1st of August, it will be from 1st of July. Depreciation method should reflect as fairly as possible the pattern in which the asset's economic benefits are consumed by the entity. Possible methods are straight line method, reducing balance method, machine hours method. A change from one method of depreciation to another method of depreciation. Suppose you are starting with straight line method of depreciation and you want to convert that into the reducing balance method, or vice versa. You started with the reducing balance and you want to continue with the straight line method. So either way, for that to happen, there are conditions which you have to comply with. The first condition is that it is permissible only on the grounds that new method will give a fairer presentation. That means only if it is a better option for you to change the method, then only you could change the method, not because you like or you dislike a particular method. It is but that you have to change the method by giving a reasonable explanation why you are changing. Is it for the betterment? Is it going to give a better representation of your financial statements? Only then it is permissible. Otherwise, it is not permissible. Second, it does not constitute a change of accounting policy. And third, it is a change in the accounting estimate. Okay, does not constitute a change of accounting policy, means that change in the method of depreciation is not a change in accounting policy. It is a change in the accounting estimate. So this point is important for you. It is second and third line, it is one and the same. It is a continuation of the second line to the third line. It does not constitute a change of accounting policy, but it is a change in accounting estimate. The carrying amount should be written off over the remaining useful life of the asset, commencing with the period in which the change is made. If an asset is made up of a number of components. Each separate part of the asset should be depreciated over its useful life. So for example, let us say that we are having an aircraft and the aircraft has got different components. The body of the aircraft, the engine of the aircraft, these are all different components. The internal seats of the aircraft. So each has got a different lifespan. So each component should be depreciated separately. Now, here they have asked illustration 3. Asset cost $100,000 and has an expected useful life of 10 years. Purchaser intends to use the asset for 6 years, at which point the expected residual value will be 40,000. What is the depreciable amount? Cost of the asset $100,000 minus the salvage value, that is $40,000. So 60,000 is the depreciable amount. Revision of useful life. An entity has purchased an asset for $20,000 on 1st of January. Straight line depreciation of 5,000 per annum has been charged. So your purchase on 1st January 20x3 and you have been charging 5,000 depreciation, assuming that it is a 4-year useful life with no residual value. So 20,000 divided by 4, it comes to 5,000. On 1st January 20x5, that means after 2 years, 20x3 and 20x4, after 2 years, the annual review of the asset lives was undertaken and the remaining useful life for this asset was estimated at 4 years. So that means the asset originally you said that it is useful for 4 years originally. But after 2 years, again you find that it is estimated for another 4 years. So 20,000 minus 5,000 minus 5,000. 2 years you have charged depreciation. So 20,000 minus 10,000. Now this 10,000 is to be further depreciated for 4 years. So each year the depreciation will be 2,500. Okay, so that is what they have given. 10,000 divided by 4 years, 2,500. Any difficulty? Anything that you have not understood?
Understood, sir.
Okay. Now, if there is a major overhauling, this is what they have said here. If there is a major overhauling or an inspection, which is supposed to take place every 3 years or every 5 years, something like that, it is a compulsion. For example, as I tell, that for aircrafts, for all vehicles, you should have a compulsory checkup. And that is necessary once in, for example, now even your 4-wheelers. After you take the 4-wheeler out for 1,000 kilometers or so, it is necessary to get your wheel balancing done, wheel alignment done, other than your normal servicing of the vehicle. Normal servicing once in 6 months you have to do. And after you travel for 1,000 kilometers, or if you are taking it for outstation drives, for example, you are traveling from Bangalore to Hyderabad, as I did when I was going. I came back from Hyderabad to Bangalore also by car. So after you travel that much long, then you have to give it for wheel balancing as well as wheel alignment. So certain things are compulsorily to be done. They are called as overhauling cost or inspection cost. In that case, they will be added to the cost of the asset and depreciated. So they have given you the example here. An entity purchases an aircraft that has expected useful life of 20 years with no residual value. Aircraft requires substantial overhaul at the end of years 5, 10, and 15. So every 5 years, there is an overall cost that will be incurred. The aircraft cost $25 million, and $5 million of this is estimated to be attributable to the economic benefits that are restored by the overhauls. So cost is 25 million, but out of this cost, $5 million is for overhauling. So the actual cost is $20 million. Actual cost is $20 million. And it has got a useful life of 20 years. So each year, 20 million divided by 20, each year the depreciation will be $1 million. Now, the aircraft you have spent $5 million for the first 5 years. $5 million you have spent for the first 5 years. So that $5 million will be depreciated by 5 years. So every year you will be depreciating 1 million. So 1 million of the cost and 1 million of the overall in cost. So total you are having for the first 5 years $2 million, which is coming from overall in depreciation and aircraft depreciation. From year number 6 onwards, what they are saying, cost of overall is expected to be $6 million. So the aircraft depreciation will remain $1 million, but now $6 million to be depreciated by 5 years. So each year it is going to be 1.2. So the total comes to $2.2 million every year. Okay. So any questions you want to ask? Anything that you have not understood?
Can you explain again, sir?
There are two things over here. One is the cost of the aircraft, which is 25 minus 5, $20 million. That has got, the aircraft has got a life of 20 years. So $20 million will be divided by 20 years. So each year it will be $1 million. So that $1 million is the aircraft depreciation. Then you have the overall in cost, which has got a cost of $5 million, which is to be paid once in 5 years. So at the beginning of the first year, you have paid this $5 million, which will be for first year, second year, third year, fourth year, and fifth year. So for 5 years. That will be also added to the cost of the asset, but it will be divided by 5 years, not by 20 years. Because as I told you, overall in cost, components cost, each has to be divided separately. Okay. So this overall in cost will be divided by 5 years. So 5 million divided by 5 years, each year it is going to be 1 million. So for the years, first 5 years, 1 million of overall in cost that you are writing off, plus 1 million of the aircraft depreciation. So total 2 millions you are writing off. From year number 6, the overall in cost is going to be $6 million. And that will be for another 5 years. So that $6 million will be divided by 5. You will get $1.2 million. And aircraft depreciation continues to be $1 million. So that will come to 2.2 from the 6th year to the 10th year. Then again, you have to see for the 11th year what is going to be the overall in cost. Like that, every year, every 5 years period, you have to see what is the overall in cost, and that overall in cost you have to divide by 5 years. Aircraft depreciation continues to remain $1 million.
Thank you, sir. Understood.
Coming to now, revaluation of non-current assets. Revaluation of non-current assets. This will be applicable under what circumstances and what are the options which are available. IAS 16 treatments. IAS 16 allows a choice of accounting treatment for property, plant, and equipment. IAS 16 says that you can follow the cost model or you can follow the revaluation model. Cost model means what we normally do. We take the historical cost minus the accumulated depreciation for each of the years, and we show the carrying amount of the asset, or what we call as the written down value of the asset. That is cost model. What is revaluation model? Revaluation model means that you have to satisfy two conditions so that you can follow the revaluation model. What are the two conditions? These two conditions will be asked in the examination, either as a part of MCQ or it will come as a part of your case study where some particular incident is given and they ask you whether revaluation model can be applied or not. So the two conditions to be complied with. First is revaluation must subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at each reporting date. So it means that if you are opting for the revaluation model, then on a regular basis, you have to revalue the asset. Now, regular basis means at least once in a year on the reporting date. The reporting date is balance sheet date. So at least once in the year on the balance sheet date, you have to revalue the asset. Second is when an item of property, plant, and equipment is revalued. the entire class of assets to which the item belongs must be revalued, not one single asset. So if it is a machinery, whichever class the machinery belongs to, all the machineries in that particular category have to be revalued. If it is a building, then all the buildings have to be revalued. You can't say that I will revalue only one building, I will not revalue the other building. So if you have an office and administrative building and you have a factory building, you can't say I will revalue the office building but not the factory building. If you are revaluing one building, you have to revalue all the buildings. Okay, so revaluation model, two conditions. If you are following revaluation model, then you have to revalue the assets on a regular basis, at least once every year, that is on the reporting date. And second item, if you are revaluing any particular asset, then individual asset cannot be revalued. The entire class of asset to which it belongs will be revalued. Okay. Then accounting for revaluation, very important, most important. Steps involved are: first step, restate the assets cost to the new valuation. Second, eliminate any existing accumulated depreciation for the asset. And third, show the total increase in OCI at the foot of the statement of profit or loss. And this will be taken to a separate account under OCI, a separate account, and that will be called as the revaluation surplus account. So revaluation surplus arises from revaluation of an asset under IAS 16. When you have a profit, so for example, let us say that you are having cost of an asset as $100,000, accumulated depreciation, you have $40,000. So you have carrying amount of the asset as $60,000. Now this particular asset is revalued to say $68,000. So restate the assets cost to the new valuation. So that is $68,000. Cancel the amount of 40,000 accumulated depreciation. Eliminate means cancel. So that means you have to find out what is not. It's not 68,000. Suppose I take it as 1,08,000. Okay, revalued figure is 1,08,000. So the first step is to show the cost of the asset as per the new valuation. That is 1,08,000 will be the new value of the asset. Second is that 40,000 depreciation you have to cancel. And third is show the total increase that has taken place in the OCI. So in this case, the journal entry that you are going to pass is debit the non-current assets, cost or valuation with the amount of the difference. Revalued amount is 1,08,000, cost is 1 lakh. So this will come with $8,000. This will be $8,000. Accumulated depreciation, you have to eliminate. How much is that? $40,000. So this will be with $40,000. And total amount transferred to OCI will be $48,000. That is equal to the carrying amount increasing up to the revalued amount. 60 plus 48 will give you 1,08,000. So that is how you pass the entry for revaluation. So the steps which are there, first take the difference in the revaluation to the cost account. So debit the non-current assets cost account with the amount of the difference, that is 8,000. Debit the accumulated depreciation account because you are going to cancel the entire amount of depreciation which is there. So debit the accumulated depreciation account with the full balance, whatever is standing to the balance of accumulated depreciation. And total of that you will transfer it to OCI account. Okay. Any difficulty?
No, sir, it's clear. I understood, sir.
Okay. recognizing the revaluation gains and losses. Revaluation gains and losses, gains are recorded as a component of OCI, just like we have explained that. Revaluation surplus. Revaluation gain is a revaluation surplus. And it is recorded in the OCI section of the statement of profit and loss account. The gain is then carried in the revaluation surplus within equity. This revaluation surplus is a capital reserve. That means it's a capital profit. Why do we need to classify this as a capital profit? Because this capital profit, once it is classified as a capital profit, it is not available for distribution as dividends to shareholders. Okay, so that means all capital profits, not only this, all capital profits, when you are having, they cannot be distributed as dividends to shareholders. So share premium cannot be distributed as dividends to shareholders. Revaluation surplus cannot be distributed as dividends to shareholders. Okay. Then revaluation, that is about revaluation profit. Revaluation losses, which represent an impairment of the asset value. So instead of increasing the value of the asset to 1,08,000, suppose it was 75,000, there's a revaluation loss. Then what to do? Then that particular loss will be directly transferred to profit or loss. But there is a catch here. There is a catch here. What is the catch? The catch is that when the revaluation loss arises on a previously revalued asset, it should be deducted first against the previous revaluation gain and can therefore be taken to OCI in the year. Any excess impairment will then be recorded as an impairment expense in the statement of profit or loss. Now, for example, in this case only, in the first year we had a OCI benefit of 48,000. And the asset was revalued to 1,08,000. Correct? Now, subsequently, if the asset is going to be revalued to 75,000, okay, revalued asset figure to 75,000. What is the difference here? The difference is 33,000. This is what? This is an impairment loss. Okay, this is an impairment loss. Now, if this is an impairment loss, then ordinarily it will be transferred to statement of profit or loss. I will take it to SOPL. But now the problem is that I'm already having an OCI. I'm already having a gain. So first that 33,000 will be adjusted against the gain. So that means this 33,000 now will be transferred to OCI because the full amount can be adjusted against 48,000. And in the OCI, the balance will now be reduced to 15,000. 48 minus 33, it will be 15,000. Okay. Suppose it had been reduced to 55,000. Then how much is your revaluation loss? It is 53,000. Now out of 53,000, 48,000 gain is already there. So this will be adjusted against OCI. The balance amount of 5,000 will be transferred to SOPL. Okay. So go through that second paragraph and see if you have understood.
Sir, what will be the entries if there is a OCI excess or loss?
For which one are you talking about?
Sir, for the now example you gave now, sir, if revaluation is 55,000.
Yeah.
We'll get 53,000 as OCI. 48,000 we'll adjust it with OCI.
53,000 is not OCI. 53,000 is a revaluation loss.
Yes, sir.
Out of
53,000
which
is the revaluation.
48,000 will go to OCI. So you will pass the entry OCI debit OCI 48,000, debit SOPL 5,000, and credit the asset account 53,000. So OCI gets cancelled to the extent of 48,000. Over and above that, whatever is there, 5,000 goes to SOPL debit, and your asset reduces by 53,000.
Okay, sir. Understood.
Okay. Now we come to depreciation of revalued assets. Once an asset has been revalued, the following treatment is required. So let us say that we have revalued an asset, and now we are going to charge depreciation on that revalued asset. Depreciation must be charged based on valuation less residual value over the remaining useful life of the asset. So whatever is a new revalued value minus the estimated scrap value divided by the remaining useful life of the asset. Whatever is the depreciation, the entire amount must go to profit or loss for the year. Any annual reserves transfer may be made from revaluation surplus to retained earnings for the additional depreciation charged on the revalued amount compared to cost. This permitted treatment under IAS 16 is to address the imbalance between a non-distributable gain held in revaluation surplus and the reduction in the retained earnings due to the increased depreciation charge. For example, let us come back to the same thing. We had the cost of the asset as $1 lakh. Let us say 4 years depreciation accumulated was 40,000. So carrying amount was 60,000. We revalued the asset to 1,08,000. So now this is the new value of the asset. Life of the asset, we divided this by 10 years. Life of the asset was 10 years. So each year 10,000 was charged as depreciation. For 4 years, I have charged 40,000 as depreciation. Okay. Now, if I'm going to take 1,08,000, now 1,08,000 will be charged as depreciation for the remaining 6 years. So if I divide this by 6 years now, the depreciation comes to 18,000 per year. Here it was 10,000 per year. So what they are saying, for the additional depreciation charged, how much additional depreciation you are charging? 8,000. So that additional depreciation that you have charged of 8,000, you can transfer an amount from the revaluation surplus to the retained earnings. So I will pass the entry debit revaluation surplus 8,000 and credit retained earnings 8,000. So from revaluation surplus, you are transferring, but that is only if the company has a policy to do so. If a company has a policy to do so, then the additional depreciation that is being charged on account of revaluation, that may be transferred to profit and loss account. And what is the reason for that? They have given you the reason also, that it is to address the imbalance between, that means your revenue profits are getting more disturbed, more reduced by an additional 8,000. So from the OCI, which is a capital profit, you are releasing 8,000 and making it available as a revenue profit for distribution as dividends to shareholders. So whatever is being deducted from your profit and loss account, you are adding it back to retained earnings so that the balance is maintained and the shareholders don't suffer because of additional depreciation. Okay, so this point is very important. So as I showed you, revaluation surplus debit or OCI debit, credit to retained earnings account. Disposal of revalued non-current assets. Disposal means sale of revalued non-current assets. Now, the first thing is that you have revalued an asset. On the revaluation of the asset, you got a profit. That profit you have transferred to revaluation surplus under OCI, and you said that it is a capital profit, it cannot be touched for payment of dividend. Now, this particular asset which you have revalued is now sold by the company after 1 year or so. It is sold by the company. So what should be done? Whatever is a profit or loss on sale, first show it in the profit or loss account. If it is a profit, credit the profit and loss. If it is a loss, debit the profit and loss. Second is very important. Whatever is the balance in the revaluation surplus account, whatever is the balance in the revaluation surplus account, you on that particular asset, I'm not talking about all assets. On that particular asset, whatever is the balance outstanding, you don't require it any longer. Why? Because asset is sold. If asset is sold, anything related to that asset, why should you keep it in the financial statement? So if that asset is sold, then that capital profit, that revaluation surplus that is arising on account of that asset is also no longer required. So you transfer that to retained earnings, saying that we don't require it as a capital profit. Okay. So any balance on the revaluation surplus relating to this asset, not all assets, relating to the assets sold, should now be transferred to retained earnings. Okay, should now be transferred to retained earnings. Why? Because we no longer require it. Because we no longer require it. If the asset is not there, we no longer require anything related to that asset. Okay. Next, we come to government grants. Government grants are government financial assistance that is given to companies for different purposes. Government grants may be given by the government to assist a company to purchase some asset, or it may be given by the government to assist the company for, let us say, incurring some expenses for the benefit of society. So it can be given either as a capital grant or as a revenue grant. So either way you can have. So if it is given as a capital grant, then it will be normally for a purchase of a non-current asset. Non-current asset means that it will be for the purchase of your say plant and machinery or land and building, something like that. Okay, and if it is given for the normal day-to-day expenditure, then in that case, normal day-to-day expenditure means for incurring some cost. Let us say that you are going to provide free meals to employees' children. That is your factory workers or their factory workers' children. You are going to provide them free meals. Then to incur that particular cost, okay, to incur that particular cost, you will be having some particular expenditure to be incurred. So government provides you assistance with that. Fine. Just a minute. Just give me 2 minutes. I'm having an important call coming. Okay, so IS 20, that is government grants. As I told you, it is capital grant either given for purchase of some asset or it is given as a revenue grant. For example, you are providing school kids with free lunch or you are giving free uniforms to the school students. Then in that case, you need to incur an expenditure. So for meeting that expenditure, some revenue grants are given. Okay. So, or some conditions are put that if you are providing employment to say 100 people in the year, then you will be getting some grant. So for employing 100 people, you have to pay them salary for 100 people. So that will incur a cost. So to reimburse you with the cost, then that revenue grants will be given to you. Okay. So either it is revenue grants or it is a case of your okay. No, but anyway, only 5 students from BMS are coming. No other students are coming. Only BMS college is coming. And only 5 students from that college are coming. And 2 students from JN are coming. So I don't think it should be affecting any other college. I'll ask the students today. No idea because I'm still having some portion to complete. Okay. So I will need some extra lectures because last week we had the continuous 4 days, 3 days of KGC. So we had cancelled the lectures. We'll have to extend the lectures. Yeah. Yeah. So I just called it for that purpose. Yeah. Okay. Okay. I'll just see the availability of students and then accordingly I'll take the lectures. Okay. No, I'm on internal control. Yes, yes, yes. I need to do that. Yeah. Sure, sure. Yes. Sorry, I had just to reschedule some lectures. Yeah. So what will be the effect of revenue grants and what will be the effect of capital grants? Let us come to the revenue grants first. Recognition of the grant will depend upon the circumstances. Meaning, if the grant is paid when evidence is produced that certain expenditure has been incurred. For example, I told you that we will be asking suppose the government is asking the company to employ 100 people every year because as you know, there is a large amount of unemployment. So government says that if you are going to employ the people, then we will support you by giving some grant, which will be sufficient to cover the cost of those employees. So that is a revenue grant. Now condition is there. So condition is there. So if you employ people and you show that I have employed 100 people in the current year. So the grant is paid when evidence is produced that certain expenditure has been incurred, the grant should be matched with that expenditure. So whatever wages you have paid to those workers, that should be matching with the government grant that you are receiving. If the grant is paid on a different basis, for example, achievement of a non-financial objective, then the grant should be matched with the identifiable cost of achieving that objective. So like this, depending upon what is the purpose of the grant, the proof has to be shown. Against that proof, that grant will be matched. Now, presentation of revenue grants, how you are going to show it? Either you can show it as a separate item on the credit side of the profit and loss, or you can deduct it from the expenses on the debit side. Okay. Coming to capital grants. This is very important. Write off the grant against the cost of the non-current asset. There are two ways in which you can treat this capital grant. Two different methods. One is, let us say your cost of the asset is, suppose your cost of the asset is 1 lakh. And grant received is 60,000. So I say minus the grant. 60,000. So net balance is 40,000. This you will depreciate over a period of 10 years. Life of the asset is 10 years. So you will say minus depreciation 4,000. This is one method of 36,000. Second method, what you will do is balance sheet asset side, you will show cost of the asset 1 lakh minus depreciation 10,000, 90,000. And grant received you will show on the liability side. Grant received 60,000 on the liability side. And this also will be written off every year. It will be called as amortization. This is called as deferred revenue. Okay, 6,000. And you will show 54,000. So every year 10,000 reduced from the asset, every year 6,000 reduced from the grant. Achha, net effect in the profit and loss 4,000. 10,000 depreciation debit, 6,000 credit, profit and loss credit. So net effect is 4,000 P&L debit. So either you show it as deducted from the asset, or you show it separately as deferred revenue. This is called as deferred revenue method. Deferred revenue method. So either you show it as a deduction from the cost of the asset, or you take it as a deferred credit or a deferred revenue. See, this is the second part. This is the first point. This is the second part. First point is reduced from the cost of the asset. This is the first point. Second part is you show it as a deferred revenue. Transfer a portion to revenue each year, offsetting the higher depreciation charge on the original cost. But net effect will be the same. Okay. Clear with this now? Repayment of grants. Sometimes grants are given and they will remain with you provided you satisfy the condition. If you don't satisfy the condition, the grant has to be returned back. Now, how much is to be returned back? That depends upon the government. The government may ask you that balance amount you return it, or the government may ask you to return the full amount also. Condition is not satisfied to return the full amount. So in some cases, grants may need to be repaid if the conditions of the grant are breached. They are not met with them. Okay. So if there is an obligation to repay the grant and the repayment is probable, that means it is most likely, then it should be provided for in accordance with the requirements of IAS 37. Okay. Now, what is that? If the deferred income method for capital grants has been used, deferred income means you are showing the grant separate, asset separate. Grant is shown on the liability side. Then the remaining grant would be repaid to the government. Any amount released to profit or loss may also need to be reversed depending upon the level of repayment required. How much is to be repaid? If the government is asking you to repay only the balance amount will be repaid. But if the government is asking you to repay the full amount, then whatever you have shown in the profit and loss, that also needs to be repaid, which means that Initially, you showed credit in the P&L. Now you will reverse the entry and debit the P&L. Okay. If the netting of method for capital grants has been used, netting of is deducting from the capital asset, then the cost of the asset must be increased because you reduce the cost of the asset first. Now you will increase the cost of the asset to recognize the full cost. So 1 lakh may say we minus 60,000 grant received. So now if the grant is to be repaid, that 60,000 we have to add back to the cost. To 40,000 again I will add 60,000 and make it 1 lakh again. Okay. So the netting of method is used, the cost of the asset must be increased to the full cost without the grant. The grant amount is cancelled. Liability will be set up for the grant repayment, but because you have reduced it from the cost of the asset shown as depreciation, so entire grant has been used. So now it is amount of grant is repayable back. So it is a obligation, present obligation, liability. Then we have IAS 23 borrowing cost. This I will do tomorrow. So till here, till government grant, just go through once again, go through the examples also, which are given, illustrations which are given, and see whether you have understood or not. Okay, up till government grants. Borrowing costs, there are some complications in the sense that what is the amount of interest? Borrowing cost is interest. What is the amount of interest that will be transferred to profit and loss, and what is the amount of interest that will add to the cost of the asset that we need to. Okay, so that calculation is a little bit tricky. So we will keep that for tomorrow. And till then, revise whatever has been done because things are going to become more and more complicated now. So we have just done the revaluation of asset. In the revaluation, we have done the revaluation first loss, first profit, then loss. Then asset is depreciated, revaluation asset is depreciated. Then we have done revalued assets sold. Now, as we go deeper and deeper, we will be having another classification of asset, which is not under IAS 16, but IAS 40. And then comes a lot of problems in the sense that if an IAS 16 asset is converted into IAS 40, or if an IAS 40 asset is converted into IAS 16. There again, if the cost model is followed, if the revaluation model is followed, so that cost model and revaluation model that we are having, go through thoroughly because we are supposed to come back to it at a later stage. Is that clear? Okay, sure. We'll stop here for today. Tomorrow's lecture, yes. I'll just confirm because I'm having a heavy schedule tomorrow. Normally it should be there because your batches are only there tomorrow. MCC batches are there. Up till 12:30, I will be in MCC only. And after that, it is like today only. No problem. No issue. I don't have any KBC tomorrow. So tomorrow it will be as usual, 2 o'clock, 2 to 3:30. No issue.
Yes, sir.
Yeah. Just revise this because you are having back-to-back lectures now. You have less time. And again, keep revising the topics that we have done earlier. Remember that we have got less marks. 8 out of 20 is not a good result. So it is like getting 40%. So 40% is not going to see you through in FR. You require minimum 50% to clear the exam. Right? So, and yes. That was only one chapter. You have to, as I increase now, you will be having more and more topics coming and it will be pretty difficult. So go through take time, at least 1.5 hours per day. You sit with your ACCA books, go through the topics, read the topics thoroughly. Don't skip any line, any word, because every line, every word, there is a meaning which you have to understand. Okay, sure.
Yes, sir. Okay, sir. Thank you, sir.
Yeah.